Procter and Gamble has rebounded about 22% or so since trading at its 52-week low back in October. And now that they've reported their Q2 numbers this week, it's time for us to answer the question investors have been wondering at this current point in time, and that is whether or not this rebound will continue further into the next few months and the next few quarters, or if now that we've already seen this slight pullback of about 7% or so since the start of January, that the stock is going to start heading lower from these levels. Well, we'll answer all those questions and more into these episodes, so make sure to stick around to the end of the video as we'll be analyzing Procter & Gamble's Q2 fiscal year 2023 results and the trajectory of this business. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we'll be starting our analysis off with the fundamental analysis of this business. We'll talk about the ins and outs of the financials, the liquidity, etc. And by the end of the video, we'll use all the information we've gathered so far in conjunction with our intrinsic value calculator to determine the buying points for Procter & Gamble, assuming there are any at this current point in time, for us value investors to profit off of. And as always, if you do enjoy this video, make sure to like the video, subscribe as well. It really helps out the channel, and we post on here regularly analyzing the businesses you are most interested in. And also make sure to comment down below the stocks that you want to see next. With all that out of the way, let's jump into the analysis. All right, and starting with their Q2 fiscal 2023 results, what do they have in store for us? Well, they said they had organic sales growth of about 5%, which is coming off the backs of a 6% decline in organic volume growth. That translated negatively towards earnings per share, but they did say that if they were operating on a constant currency perspective, it actually worked out to about a 5% increase in that earnings per share growth year over year. You know, they do have a multitude of brands that you probably use on a daily basis, so there's definitely a reason why this business has had the longevity and success that it has to this point. But if we look at this from this quarter's perspective, how did their wide variety of products actually perform? Like we mentioned, volumes were down altogether about 6% for the company. Forex impacts were at a high here at another 6%. Now, they were able to actually increase their prices across the board there for their products about 10% company wide, but altogether that left them with about a negative 1% sales growth across the company. How does this actually look from a graphical point of view? Well, we can see this downtrend over the past few quarters in growth, not necessarily something investors are going to be looking forward to, and obviously the management team is going to want to turn that around slightly here. But if we do look at this from a fundamental perspective here, we can see their revenues came in with about $20.7 billion for this quarter alone. Strong numbers there. However, it is that 1% decline year over year. Now, whenever we see a decline in revenues, the next thing you want to see is what happens with their expenses. Well, those actually ended up increasing. So what's naturally going to happen is we're going to have a gross profit down about 4% now for this quarter at least. Then we add on our selling general admin expenses, and we're left with $4.7 billion of operating income, a 7% decrease year over year. All right. So again, once you see those margins being hit there on the gross profit side, you'll see that follow its way all the way down to the earnings and bottom line of the business. That being said, if we look at this chart here from today's video sponsor, Main Street Financial Data, the first link in the description here, we can see once again from a graphical point of view how the business has performed over the last few years, at least in terms of revenues by their segments. You can see there has been growth here, although not linear growth, it is growth all the same, and that is exactly what you are going to want to see from a business that you're looking to invest in. You know, growth never has to be linear, but as long as the fundamentals are improving, that's the main point. Now, in terms of the next year or so, they actually produced their guidance here. They say that they do actually have potential headwinds ahead, you know, in the form of significant deceleration of their market growth rates. You know, they're expecting that there's going to be more Forex challenges in the future. Supply chain expenses should probably increase. So they're expecting disruptions there. And especially if there's any geopolitical risk in the future, you know, we already have a war going on still, which has had global impacts to the economy. You know, other countries are starting to get involved. So we'll see where that takes us as well. The markets definitely do not like war. So that leads us down here to our balance sheet overview, which is a chart produced by Main Street as well. I've gone ahead and annotated the amount of cash that they have on the balance sheet here. It's about $7 billion worth. So when you look at this from a high level perspective, you can see here assets have been decreasing, but they still have more assets than liabilities. So that leaves them with equity in the business, although it has been declining over the most recent years. But again, if we look at this from this quarter's perspective, at least at this current point in time, they have about $7 billion of cash And if you look up here, debt due within 1 year, $14.3 billion. So they only have about half of the cash that's required in order to pay down that debt. So you know what that means automatically. They have about $20.5 billion worth of debt at this current point in time. But whenever you see that they don't have the required amounts of cash on the balance sheet to pay down debt that they need to service, well, what's going to happen is if we look here at our free cash statement, although for the 3 months they produced about $3.5 billion in cash from operating the business, spent about $700 million on expenditures, leaving them with about $2.8 billion in free cash flow. For a 6 months period, let's just say that was about $5 billion or so in free cash. I mean, they paid out almost all of that towards their dividend, and the rest all has to do with their debt consolidation here, where they're taking on some more debt to pay down debt, whether it's short-term or long-term. And then they're also spending money to buy back shares. Now, not a fan of this strategy right here where they're taking on debt to service shareholders, because we know how that works out. And especially when this business has declining levels of equity, it seems like the liquidity here is suffering just a little bit. If we look at this from a guidance point of view for this next year, they're saying that they're expecting around 4 to 5% growth, at least organically. And if we look at this from a cash generation and usage point of view, they're expecting 90% cash flow productivity, with about 5% of their sales being spent on capital expenditures to maintain and grow the business, with about $9 billion being spent on dividends by the end of the year, and then another about $6 to $8 billion spent on repurchasing shares. Not my favorite strategy ever. I think instead of repurchasing the shares, they should really be lowering those levels of debt, because we've seen how that negative trend in equity has impacted this business slightly here. Now, if we look at this from an income overview here from this Main Street chart, we can see here on an average scenario, they have been able to produce, at least in terms of operating income, around that $15 billion or so mark on a year-over-year basis consistently. So if we enter that into our calculator here, and we expect a 10% return, they do currently pay a dividend as well, and we expect normalized growth at around 4 to 3% over the next 10 years, while trading at a 25 PE like they're currently staying at right now. The stock should be worth about $140 per share. Well, that's exactly the price range that they're kind of trading in at this current point in time. So technically, from a very fair 10% required return scenario here, the stock is actually fairly valued at this current point in time, assuming they can grow about 4 to 3% for the next 10 years into the future. Now, in the very best case scenario, let's say they can actually boost that growth rate, interest rates start to get cut, there's less geopolitical risk in the market, etc. They can grow at 7% for the first 5 years. That drops down to a normalized rate at 4% on a 30 PE. The stock will be trading at about $185. So some decent upside. We've already seen this stock up at $162 before, so that really wouldn't be too far off those levels there in the very best case scenario. Now, in the very worst case scenario, let's say for the next 5 years, they continue on this downward trajectory here, negative 1% growth for the next 5 years. That stabilizes out at just 2% growth for the 5 to 10 years after that. On just a 20 PE, the stock would actually tank quite significantly down to about $93 per share or so. So that'd be back down to those 2020 lows in what we would consider on this channel, at least the worst case scenario. Definitely something to think about. You've seen their product array. I'm sure you can go into your kitchen or your bathroom and find a bunch of their products and their brands in there as well. So it is a stable business with longevity and lots of different brands. So if this is something that interests you from a portfolio perspective, let me know in the comments below. Also, if you made it to this point in the video, like the video, subscribe. It really helps out the channel. Also, make sure to comment not only your thoughts, but also the videos you want to see next in the comment section below. And with that, I'll catch you on the next one.